Welcome back to Investing Talk Podcast.
Today we're looking at Alexandria real estate equities. The big question is it a good time to buy now?
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Okay, so diving into the materials on Alexandria real estate equities, the first thing that really jumps out is they're not your typical office landlord, the ones struggling right now.
Oh, absolutely not. They have this really strong competitive position, a moat, as you'd say.
Right. How would you describe that moat exactly?
Well, they're basically the premier owner and operator for life science campuses. And crucially, they're only in what they call these AAA innovation cluster locations.
So we're talking top-tier spots.
Exactly. Think Boston, the SF Bay Area, San Diego, New York City. These are like highly specialized areas. They're ecosystems, really, not just office parks.
And these are places where R&D companies kind of have to be, right? High barriers to entry.
Precisely. You can't just build a state-of-the-art lab anywhere. And that focus, that location strategy, it directly impacts who their tenants are.
Yeah, I saw that tenant list. It reads like a who's who of big pharma and biotech. Real blue chip names.
Right. And these aren't companies signing short leases. We're talking 10, 15 years sometimes.
Yeah.
That scale, that tenant quality, that's the foundation of their competitive advantage. It's tough for anyone smaller to replicate.
Okay. Quality locations, quality tenants. Does that show up in the numbers? How's the actual business performing?
It really does. And this is important, especially given all the, negative headlines about commercial real estate in general. Their revenue resilience is actually pretty remarkable.
How so?
Well, for the full fiscal year 2024, their revenue climbed 8.2% year over year, reached about $3.12 billion.
Wow, 8% growth in this environment. That's strong.
It is. It signals that the demand for their specific kind of space, this high-quality lab and R&D space, it's still very much there, even if, general office leasing is soft elsewhere.
Okay, strong revenue. So for investors, especially those looking for income, I immediately think about the dividend. How does that stack up?
Ah, yes, the dividend. It's definitely an attention grabber right now. It's acting like an income magnet.
What's the yield looking like?
Currently, it's yielding a huge 9.47%. That works out to $5.28 per share annually.
9.5%. That's substantial. Way above what you typically see from REITs, isn't it?
It is much higher than average peers, yes. And look, whenever you see a yield that high, the immediate question is it safe? Is it sustainable?
Exactly. Can they actually afford to pay that out?
And this is where we need to talk about FFO, funds from operations. It's a key metric for REITs, and you really need to understand it.
Okay, break that down for us. Why FFO and not just, say, net income?
Great question. Because net income for real estate companies includes massive non-cash charges, mainly depreciation. Real estate assets are depreciated on the books, even if their actual market value is stable or increasing. FFO adds back that depreciation and amortization.
So FFO gives you a clearer picture of the actual cash being generated by the properties.
Exactly. It's much closer to the cash earnings available to run the business and pay dividends. And the key point here is that Alexandria's dividend is well covered by their FFO.
Meaning they are generating enough cash from operations to support that nearly 10% payout.
That's what the analysis suggests, yes. Which provides a pretty significant layer of comfort for that high yield.
Okay, this sounds almost too good to be true. Strong niche, growing revenue, blue chip tenants, massive dividend, covered by cash flow. So why the disconnect? Why is the stock trading so low that we're even asking if now is a good time to buy? What happened?
Right, that's the crux of it. It all leads back to the recent volatility. The market really didn't like what it saw in the Q3 earnings report.
What was in that report?
Well, the headline number was a net loss for the quarter of about $232.75 million.
Ouch. A net loss is never good.
No. And that, combined with them lowering their earnings guidance for 2025, definitely spooked investors. That's what triggered the sharp sell-off.
But you said net income can be misleading for REITs because of things like depreciation. Was there something else going on in that Q3 number?
Yes, absolutely. And this is the critical detail you have to grasp. That headline loss was almost entirely driven by a huge one-off non-cash charge.
Non-cash, what kind of charge?
It was a $323.9 million real estate impairment charge.
Okay, impairment charge. What does that actually mean in plain English?
It means management decided that the value of certain properties on their accounting books was higher than their current estimated market value, so they had to write down the difference. It's an accounting adjustment.
So it's not like they suddenly had to spend $324 million. It wasn't cash going out the door.
Correct. It's a non-cash accounting hit. It reflects potential pressure on property values, maybe due to higher interest rates making deals look less attractive, or perhaps some softness in leasing in specific spots, but it's not an operational cash loss.
But the market reacted like it was a disaster.
Pretty much. Seeing that big negative net income number, the market panicked. The stock dropped almost 25% right after the report. It seemed like a classic overreaction to an accounting event rather than a fundamental business collapse.
Okay, but even if it's non-cash, an impairment charge isn't good news, right? It does point to some risks.
Definitely. You can't just ignore it. It absolutely highlights that asset valuation pressure is a real thing across the sector. And it signals that management needs to be on top of any pockets of leasing softness to keep occupancy high.
And does their business model itself have inherent risks? You mentioned the focus on life science earlier.
Yes, that concentration is both a strength and a potential weakness. Relying heavily on big pharma and biotech gives them stability, those long leases we talked about. But, if that specific sector hits a downturn or if there's major consolidation among those key tenants, it could create vacancy issues. It's a risk factor to keep an eye on.
So managing that concentration, addressing any leasing softness, that's the challenge for management.
Exactly. Now, let's shift gears and look at the technical picture, the stock chart, because this is where the potential opportunity, that asymmetry, really starts to show.
Asymmetry meaning the potential upside looks a lot bigger than the potential downside.
That's the idea. Right now, the stock's hovering around $58 a share. If you look at its 52-week range, the low is about $55, and the high was way up near $116.50.
Wow, so it's trading much closer to its lows than its highs.
Very much so. And interestingly, even after that rough Q3 report and the big drop, the stock found really solid support right around that $55 level. It bounced off it multiple times.
And so buyers stepped in around $55,
Yeah.
suggesting something could hit a floor.
It suggests that, yeah, it implies there's a level where enough investors believe the underlying assets are worth at least that much, regardless of the quarterly accounting noise.
Okay, so the price is near the bottom of its range. Support seems to be holding. What are the professional analysts saying? What are their price targets?
This is where it gets really interesting. The consensus analyst targets for the next 12 months are generally clustered somewhere between $93 and $97 per share.
93 to 97, compared to a current price of $58.
Yep. That implies potential upside of, 65% to 74% from current levels? It's a massive gap.
So analysts are overwhelmingly positive despite the recent sell-off.
Largely, yes. Most ratings are buy or outperform. They seem to be looking past the temporary Q3 impairment and focusing on the long-term value of these unique life science properties. They essentially see the current price as a dislocation.
And are we seeing signs that big investors, institutional money, agree with that view?
The trading dynamics suggest they might be. While volatility obviously spiked after Q3, it has started to calm down. And the fact that the price stabilized above $55 despite the bad news suggests accumulation. It looks like larger players are using this dip to build positions.
So they see that risk-reward asymmetry too. Favorable bet at these levels.
It appears that way. They likely view the combination of the depressed price, the strong underlying assets, and that high dividend yield as a compelling setup where the potential reward outweighs the perceived risk.
Okay, so if the stock is potentially oversold and analysts see huge upside, what needs to happen to actually close that gap? What are the catalysts that could drive a recovery, especially soon?
The most immediate and I think most important catalyst is net operating income, or NOI, acceleration. This is tangible cash flow improvement.
How much improvement are we talking?
The company expects its annual NOI from projects that were recently delivered, so brand new buildings basically, to jump by $50 million over just the next 3 months.
$50 million. How is that happening so quickly?
It's mainly due to the burn-off of initial free rent periods. When they lease up a new building, they often give the tenant, say, the first few months rent-free as an incentive.
Like a move-in special.
Exactly. And for several big projects, those free rent periods are ending right about now, so the full rent payments start kicking in. This isn't hoping for new leases. This is contracted rent coming online.
So that's a near certain boost to cash flow hitting very soon.
Pretty much locked in, yeah. And looking a bit further out, their longer-term development pipeline also looks quite strong and de-risked.
What does that pipeline look like?
Projects set to be delivered between the start of 2025 and the end of 2026 are expected to add enough annual NOI to represent nearly 8% growth on top of their total 2024 NOI.
Okay, significant future growth baked in. Is that leased yet, or is it speculative?
That's the key part. About 85% of that future pipeline space is already leased.
85% pre-leased, wow.
Yeah, so they have pretty good visibility into growth, not just next quarter, but for the next couple of years, largely secured by existing contracts.
That sounds like it really reduces the uncertainty, which must make the next earnings report pretty critical.
Absolutely. The Q4 and full year 2025 earnings announcement, likely coming in late January 2026, is the next major checkpoint. All eyes will be on management's commentary.
What are investors going to be listening for specifically?
Two main things, I think. First, any positive updates on leasing momentum? Are they signing new deals at good rates? Is demand still healthy? Second, and perhaps even more crucial, confirmation that the Q3 impairment was an anomaly.
Meaning no more big impairment charges in Q4.
Exactly. If they can show stable asset values and continued leasing strength, it would go a long way towards rebuilding confidence and proving Q3 was just a one-off hit.
Okay, operational catalysts, pipeline visibility, earnings report. Anything else bubbling under the surface? Any speculative angles?
Well, whenever you have a high-quality company trading this far below its recent highs and certainly this far below analyst targets, you start hearing chatter. The sheer size of that $55 to $116 range over the past year definitely raises eyebrows.
Chatter like what? Activist investors, maybe?
That's certainly one possibility. Activists often look for situations like this perceived undervaluation in a company with good assets, where they think they can push management to unlock value.
And how might they unlock value here?
One speculative idea revolves around their mega campus ecosystems. These are their largest, most integrated campus environments, where something like 76% of their current development pipeline is focused. They are incredibly valuable assets.
So the idea would be spin them off.
Potentially. Spin off those prime mega campuses into a separate pure play entity to highlight their value, maybe attract a higher valuation multiple. It's purely speculative right now, but that kind of financial engineering is something the market might anticipate given the depressed stock price.
Interesting. So let's try and tie this all together. What's the overall investment thesis here?
Okay, so you've got this core tension, right? On one hand, you have these strong near-term catalysts like that NOI boost coming online and a solid pre-lease development pipeline.
But on the other hand,
you have this lingering skepticism about the commercial real estate sector generally, which got amplified for Alexandria specifically by that big Q3 impairment charge.
so balancing those factors, what's the bottom line? Bullish, bearish.
Based on the analysis, the overall view seems to lean pretty strongly bullish. I mean, if we had to score it, maybe an 8.5 out of 10 in terms of attractiveness.
What drives that bullish conviction?
It really comes down to the fundamentals. Owning premier, hard-to-replicate assets in a resilient niche, that very high dividend yield which appears covered by cash flow, FFO, and this technical setup where the stock looks quite oversold and seems to have found institutional support near the lows.
Okay, so if someone finds this compelling, what kind of investor is it best suited for? And what's the time frame?
Well, it could appeal to a couple of different types of investors, I think. For more tactical traders, maybe those comfortable with volatility, there's potential near-term play here.
Like trying to capture a bounce?
Yeah, maybe aiming for a 10%, 20% rebound if that Q4 earnings report delivers on the NOI acceleration and shows no further impairments. Execution on those near-term catalysts could spark a quick re-rating.
And for longer-term investors?
For them, it looks arguably even more compelling. If you're patient, you get paid that hefty 9.5% dividend yield while you wait. You're investing in what seems to be the sector leader with resilient growth prospects, currently available at a significant discount. The bet is that eventually the market will recognize the underlying value and close that valuation gap.
So attractive for traders looking for a catalyst-driven bounce, and maybe even more so for long-term investors seeking yield and eventual recovery.
The critical test ahead is this. Can management execute on its capital strategy and leasing goals over the next 90 days to decisively prove the Q3 impairment was an anomaly and not the start of a concerning trend?